Hello students and welcome to the model 6 of financial derivatives. So here we will discuss about the topic on the forward rate agreement or the interest rate futures. More or less we discuss about what are the different types of interest rates that we come across and understanding the conceptual way of how these interest rates do function. Okay. Before we get into understanding what are the different types of interest rates, we need to understand that the financial institution, let it be a bank or a non-banking institutions which are operating in the commercial banks or in the money market instruments, right? So they might be in need of the requirement of liquidity. It may vary, the liquidity needs that vary from minute to minute and a day or for in a week or so. Right, to meet the these liquidity requirements as a statutory or to meet their obligation, right. So they will be participating in the various markets ranging from the short term to the medium term markets to meet their requirements. So hence here we will discuss about the various types of interest rates that we come across that helps in terms of meeting the obligation of these financial institutions. Okay, so let's discuss the first type of interest rate that we come across here, what we call as a treasury bill rate. All right, this is more familiar, more popular type of an interest rate that we come across, what we call as a treasury bill. As you all know that right now the government has been facing a huge fiscal deficit, right, and these treasury bills plays a very important role when the government is facing a huge fiscal deficit. Here the RBI would be issuing the treasury bill bonds which has a higher denomination value to raise the capital to meet the government physical, right. If you just currently if you just look at here, right, across the world the equity markets are anticipated to have very volatile and showing a downward direction. But since if you just compare the similar scenario into the bond market or to the debt market, right, so you find that there is a upward trend or an upside anticipation or upside trend into the bond market, because every government's regulatory, right, so they will start issuing the bond to the institutional investor to raise the funds to meet the financial deficit of the country. So hence these treasury bills plays a very important role when there is a fiscal deficit. Right now this is more popular instrument, right. So government says that we want to raise, or it has a financial package of 1.25 lakh crore, right, to meet the current expenditure or the fiscal deficit. So this is possible where the RBI has been issued the treasury bills and raise the capital and supported the government to meet the expenditure. Fine, this is about like treasury bill. So we don't come across much in detail about this. Just to understand about what are the types of interest rates, we will be trying to more detailedly look at about the practical aspects only with respect to the zero rate and the forward rate and the par yield. The rest all to have a conceptual understanding. Then comes the LIBOR rate, right. You might be familiar this LIBOR rate in the international finance. So LIBOR rate is nothing but London Interbank Offer Rate. This is like offer rate and the bid rate. That is nothing but buy rate and the sell rate. So LIBOR rate, that is offer rate, where the banks are what you call as simple, it is called as a floating rate. So we might be familiar with the fixed rate and the floating rate in the swap transactions, right. So LIBOR rate is as simple like in a floating rate of interest which has been prevailing. That is the offer rate. That is the buying rate, right. If you wanted to buy the instruments, at what rate, what floating rate the government has been issuing, that is called as an offer rate. So we use LIBOR, that is from the international market. From the domestic market we can use it as a MIBOR. We have like Mumbai Interbank Offer Rate. Similarly LIBID stands for London Interbank Bid Rate, right. Any interest rate if you look at, there is a bid rate and the offer rate, that is buying rate and the selling rate, right. So these are the two rates of interest from the point of the institution. That is buying rate, at what rate you will buy the instrument, at what rate that you will be selling the instrument, right. Then comes repo rate. right? Repo rate is a rate of interest that RBI would be charging, or RBI would be lending the money to the various financial institution, or particularly let's say the commercial banks, right? Commercial banks need to maintain the statutory liquidity or the statutory cash requirement as per the RBI guidelines on a day-to-day basis, right? To meet the cash requirement on a day-to-day basis, right, the commercial banks can directly borrow from an RBI for a single day. The next day they are supposed to repay the amount, right? Such a rate what we call as that a repo rate. Then comes the call rate. Call rate is a rate which is for the money market instrument. As you know, see that there is a different long term instruments. So money market instrument, if you wanted to buy for a shorter period of time, right? So here the time starts from a day to the maximum of 14 days. Within the 14 days, you have to close the contract or you have to repay the amount what you have been borrowed, right? Such any transactions, such type of borrowing and lending, what we call that as a call rate, that is only applicable into the money market. Whereas a repo rate, that is between RBI and with the commercial banks. Right. So, the one of the advantage what we find into the call rate is you do not require collateral security to be pledged, but almost it will have in a higher what you say the risk, and also the rate of interest would be the higher than the any other instruments. Then comes a zero rate. So, what are these zero rates is all about, right? Zero rate is nothing but zero coupon rate or a deep discount rate, where the institution or the financial institution which issues the bonds at a zero coupon. It means there is no coupon where the bonds are being issued at very deep discount. Such rates what we call as at a zero rate. Then comes the forward rate. Now, what is this forward rate, right? If you wanted to anticipate the coming interest rates, what could be the possible interest rates in the near future based on the historical zero rate, that is the present and previous minus, right? For taking a duration of past interest rates or the two interval of time. If you have the zero rates for the two interval of time for the past or the historical zero rates, by which you can able to predict what would be the forward rate in the coming days, right? That is about the forward rates. Next comes CBLO, that is collateral borrowing and lending obligations. What is this collateral borrowing and lending obligation? It is quite similar to that as a money market instrument, how it functions. The only difference that you find between the CBLO and the money market instrument is the collateral of the securities. In CBLO, right, which is been monitored and controlled by a clearing corporation of India, that you might be familiar with National Clearing Corporation of India, which is a wholly owned body of a government, right? It manages this CBLO, where any financial institution would need of the cash, immediate cash, right, can borrow the money for a shorter period of time, right, by collateralizing their financial securities. These financial securities are those which are having highly secured in nature. Okay. So, here what happens, we can lend the loan and borrow the loan by collateralizing the securities. Such type of interest rates what we call as in a collateral borrowing and lending obligations. Then comes the interesting, it is par yield or par rate. Now, what is this par yield and a par rate, right? As you know that the bond which has been sold into the market, right, it can be sold in the market for a premium or can be discount, but the coupon rate of the bond remains the same, right? The face value of the bond is different, the current market price of the bond is different, right? If you buy the bond at the difference into the price, it means it is not as same as the par value or the face value of the bond, right? And you every duration, that is for 1 year or 6 months, you will be keep receiving the yield to mature, you will be keep receiving to the coupon rates, right? When you reach to the end of the bond, that is life of the bond comes to an end, right? So, what we call as a yield to maturity, when the bonds get matured, right, that is expire the life of the bond, what is the yield, what is the return, right? When there is a variation into the price of the bond in the market, when you purchase the bond, there is a possibility that yield to maturity will not be the same as the par yield, right. So, when there is no difference in the current market price and the par value of the bond, what we call as a par value, nothing but the face value of the bond. When the face value of the bond and the current market price are the same, then yield to maturity, nothing but yield return if you hold till maturity, would be the same as a par yield or the par return. This is what we call as a par rate or par yield. What is the return that you have been earned by holding the bond till maturity, right? If there is a variation into the stock price, then the yield to maturity and the par yield would be the difference. If there is a no variation into the stock price, right, then the par yield would be the yield to maturity. In simple yield to maturity, as we discussed, it is nothing but holding period return. If you buy the bond and hold till the date of the maturity, what is the return that you have been earning is called as a par yield. Fine. With this conceptual understanding of the different types of rate, possibly the question may come to you, what are the different types of interest rates that you come across, or describe or define CBL or define zero rate or forward rate. These are the possibilities of questions that may come in the examination, right. In the next class, we will take up about the problems which are very important from the point of examination. Thank you.